Welcome back. I am pleased to segue us to our third and final panel on where we'll share some public company perspectives and some considerations for IPOs and small cap companies. Our moderator this afternoon will be my colleague Luna Bloom from the SEC's Division of Corporation Finance. Luna, I will let you take over.
Great, thanks so much, Amy. Great to be here this afternoon. It's been a very lively discussion so far, and I'm really excited to moderate this last panel talking about public company perspectives. So both considerations for when it's time to IPO, and then some, interesting feedback and insights into what it's like to be a public company. We'll dive right in because we've got a lot to talk about. So I'll pass it over to our panelists to introduce themselves briefly before we get into the meat of things.
Perfect. Hi, everybody. So I am Sean Duffy. I am the co-founder and CEO of Omada Health. I am not your transportation secretary, so often confused. Omada, we're a virtual care company. We provide between-visit care for people with obesity, prediabetes, diabetes, and hypertension. Really, the care areas where we felt that yesterday's care model, handcuffed in visits, was the wrong care model, and so had the realization while in medical school that we needed something different. And fast forward, we listed the company on the NASDAQ last June, and honored to be here.
Thank you, Luna. Reed Hooper from Cooley LLP here in Washington, D.C. My practice primarily exists of representing public companies in their ongoing SEC reporting and corporate governance issues. I actually began my career here at the SEC about 14 years ago, and I spent many days and meetings in this room in particular, including I took LLM courses at Georgetown in this room, so a lot of good memories. So it's great to be back, and thank you for having me.
Hi, good afternoon. I'm Nolan Townsend, CEO of Lexeo Therapeutics. Lexeo is a clinical stage biotechnology company focused in gene therapy for genetic cardiac disease and Alzheimer's disease. I was the first employee and co-founder of Lexeo. It's a company that's been in existence for about 6 years, and we took the company public at the end of 2023. So look forward to discussing that journey.
Good afternoon, Josh Colburn with Faegre Drinker Biddle and Reith out of the Minneapolis office in our corporate group. I also represent a lot of public companies. I tend to get the smaller reporting companies, but all the way from 2 billion on down to the smallest public companies you've probably heard of. And a lot of companies that have either slim or no in-house counsel, so we end up taking all the soup to nuts, SEC reporting, compliance work, capital markets, and running that through as if we're in-house.
Great, thanks everyone. I think from what you can hear, we've got an excellent mix here of public company CEOs and their outside counsel representation, so I think it's going to be a great discussion. With that, Sean, why don't you kick us off? As a co-founder and CEO of a company that went public just last year, can you let us know, kick off the conversation by telling us a little bit about your company or a little more about your company? What considerations led your team to take the company public, and what was your IPO experience like?
Sure. Well, let me just start with our mission at Omada Health, which is to bend the curve. And so in the early days of Omada, when I founded it, I was in med school, and I always told the team that, look, our company will be successful if we notice that tomorrow's epidemiologists see a bend in the curve, and some of that can be attributed to Omada. And so, the goal, again, is to help the 156 million Americans who are suffering from chronic disease that are living in a care model where the often experience is the patients with their doctor, and they say, you have diabetes, why don't you take these meds, lose weight, check your sugars, eat differently, come back in 6 months. Which of course doesn't always happen. So that's been the mission from day one, and we've built really a between-visit care experience full stack that works within the constructs of the U.S. healthcare system. And it's been bridging to the topic at hand here. It's been a remarkable journey, and it's one where I'm privileged to having gone from the back of zero experience, 27 years old, didn't know what a VC was, taking our first angel check to taking the company public. And so it's been very fascinating to see every aspect of the capital stack. And again, we listed last June, which was a neat milestone for the business. And a couple of reflections, germane to your question on kind of the process and the timing. I'm often asked, well, how did you know it was the right time to go public? And the way I've started to view it is there's the gut side and then there's the quant side. And the gut side, the best analogy, I think, for those of you with kids you may resonate, is what is the right time to have a kid? And there's never going to be a perfect time. It's, you can think all day long about the external factors and, the location or we might move, and who knows? You can overthink that ad nauseum, and I see some smiles in the audience. So that's where my wife and I were too. But then at the end of the day, where are the fundamentals, and do those feel right? And that's, do you have a durable relationship? Like, is the family setup right to ensure that this new child that you may bring to the world can thrive? And those are the most important. And with a company, it's do you feel that the organization has matured such that it can be durable, and has the chance to build equity value on the public markets based on the characteristics that they need: reliability, operational maturity, performance, et cetera. And I think until you feel that first box is checked, you shouldn't think about it. So that's the gut side. And the quant side, I mean, we were blessed at time of IPO with back-to-back 38% years of revenue growth, durable trends on top line, margin improvement, durable trends on bottom line. We just had our earnings call reporting on Q4 of last year, and last Thursday, and so we're just north of $250 million in revenues, growing 53%. And so we had a lot of tailwinds, especially within the GLP-1 space. I'm like, you know what, the enterprise is ready. Yes, it's there's volatility in the markets, but it felt like the qual and the quant was right. And then last, and then I promise I'll stop talking on the process. Interestingly, it's both more difficult, but it's so much clearer than the private rounds. I mean, the way you raise a Series C has a ton of variance as an entrepreneur. The path to going public, has a lot of consistency. And so I remember, doing these banker meetings, and they're building out the roadmap and the game plan and the do this. I'm like, you just do that for free until we choose to work for you? Like, you're giving us like all the details on the house? It was such that the organization was ready. I was actually pleasantly surprised with how clear the process was.
That's super helpful. And Nolan, I'd love to turn it to you to share your company's IPO story. Can you similarly talk about your company? Why did you choose to go public when you did, and what was that process like?
So I'd say in somewhat a similar story, although the dynamics in the biotechnology sector are different. There's a very long runway from typically company formation to when a biotechnology company generates its first dollar of revenue. This occurs after an FDA approval, but as many will have heard from different sources, it takes about $1 billion of capital to get from the start of a drug program to an approved drug. So typically, that's an 8 to 10 year journey and $1 billion of capital. We are that story. We've raised, about $800 million of capital, and yet we're still probably a year and a half away from our first drug approval, so our first dollar of revenue. So that in a way, I think underlies the interest of a lot of companies to pursue the public market path in biotech. If you think about a private round, it takes 4 to 6 months to pull a private round together. So you're already on an 8 to 10 year journey. Imagine you had these 4 to 6 month interludes in between each stage of your pipeline to raise that next round of capital. Whereas in the public markets, you can raise a round of capital in 4 days. So that's the ability to form capital around the pipeline and do it in a rapid and flexible manner in the public markets is why a lot of biotechnology companies consider that pathway. For us, the time to go public was when we saw a sufficiently mature pipeline such that we didn't have to evolve the company story any further. It's much more difficult to evolve the strategy and the story in the public markets than it would be to do that kind of work in the private markets. I think you also want, in the biotech sector at least, get to a certain stage of maturity where you believe the probability of success of getting to an approval is very high, so therefore you're not looking at a major drug pipeline failure in the public setting. You'd rather make the kind of changes you need to make in your pipeline in the private setting. So I think it's a stage of pipeline maturity, but an interest in capital formation that can occur rapidly is sort of what sits behind our journey to the public markets, and certainly would be the case for a lot of other companies that are on a similar path.
Great, thanks so much. Reed, I'd love to turn it to you. As a counsel to public companies and investors, let's take a step back and kind of look at what's happening in the IPO market generally. Are there any trends that you can share? And, from there, if you think there are any trends to share, are there potential changes that the commission should be considering to encourage more companies to go public?
Yeah, so I think, if this panel and this forum was held maybe 10 days ago before some of the recent geopolitical conditions that occurred, maybe the answer would have been a little different. But I guess at the same time, there is a lot of optimism right now in the IPO market. We had some macroeconomic challenges over the past few years that slowed things down a bit with respect to high inflation, high interest rates. We saw data, though, towards the end of the second half of 2025 that really was encouraging, that I think provided a lot of optimism for the 2026 outlook. And so I think, a lot of that hasn't changed. We did see some of the VC-backed larger scale IPOs get delayed a bit in 2025, but I think we've seen kind of those move forward now, and I think there's just a general optimistic outlook for the next year, despite the recent events that we've seen on a geopolitical level. With respect to what the SEC could do for encouraging to make IPOs great again, as Chairman Atkins consistently speaks about. I think from a smaller company perspective, it's a different lifestyle to be a public company than from the larger scale companies. There are increased costs. There's disclosure regime that is somewhat consistent, almost substantially similar to some of the larger scale public companies out there. And so I think, I'd like to say there's probably three ideas or buckets that I generally put it in. And one is, reducing friction within the rules while at the same time not reducing transparency. And so I think what I mean by that is, for a lot of these smaller public companies, in particular in the life sciences space, when you are starting that IPO on-ramp, the communication with your customers, with analysts and with other third parties needs to stay consistent. I think because a lot of their story around their valuation is very important for them as they go through the IPO process. And I think Nolan and Sean can attest to that and discuss it if they wish. But I think a lot of that, when you go through the IPO and you file your registration statement, there's certain quiet period restrictions that I think pose an issue for many public companies to potentially delay an IPO if there's certain communications that are considered potential gun jumping issues. And so I think from a smaller company perspective, to perhaps loosening some of the IPO communication rules or providing some safe harbors around them so they can consistently discuss and have conversations with third parties around what they envision their story to be post IPO is important, because a lot of these smaller companies, they lack the research coverage, they lack the analyst coverage, and so to be able to kind of build that up and then up to the IPO and then through it, I think would be important. The second one, Chairman Atkins touched upon, is scaling the disclosure requirements with the size and maturity of a public company. That's obviously a big focus of what the current SEC and Chairman Atkins' agenda is, and I think we've seen a lot of that with Regulation ASK reform project that is underway, and I think it's critical for a lot of these smaller public companies to be able to look and say, look, I'm not the largest tech companies out there. I don't necessarily need to provide the same disclosure for these various areas that they do. So I think scaling that down, and I know we've talked about the option for quarterly reporting to potentially move to semi-annual reporting. I know in the life sciences space in particular, the quarterly earnings process is not as quite material as it is for the other larger scale companies. And so the ability to perhaps maybe provide quarterly business updates for these type of companies and just provide semi-annual financial statements is something to think about as well. And then finally, just reducing the cost. The cost of a public company is obviously very high, and it's increasingly high for the smaller public companies. And so the ability for these companies to potentially not have to comply with, for instance, the Sarbanes-Oxley auditor attestation requirement, 404B, and pushing that back to, or increasing the threshold for when these companies would be able to comply with that, or not have the ability at all to comply with that, would be highly beneficial, I think, for a lot of these smaller companies. Because we see actually in our space a lot of our public companies that are teetering on the accelerated filer status to smaller reporting company status, and potentially, how volatile their stock is. One year they may be an accelerated filer, one year they may drop down to a smaller reporting company, but at the same time it's difficult to scale back if you're already in the 404B land, that whole process. And so what they do is a lot of our clients will just continue to pay the extra costs and just be ready in case they go back up to that. And so I think kind of streamlining that so they don't have to essentially, have those costs would be highly, highly beneficial.
Great, thanks, Reed. And I think folks probably heard underlying my question to you about what could the commission do to encourage more companies to go public, suggest a viewpoint that we should be encouraging more companies to go public, right? And that I think has some notable benefits that we're discussing today, both to companies and to investors. So Josh, I'll turn it to you, since you also advise companies and investors on the public markets. What would you say are some of the benefits and challenges that you might highlight for clients, especially smaller companies that are going public or considering going public? And I'll likewise pitch to you the question of, are there regulatory changes the SEC should consider or improvements to ramps onto the public markets?
Yeah, and I'm going to piggyback with Reed just briefly. On 404B, it seems like a year is a long time to get that in place, and oftentimes you can see it coming, but it's always a chase at the end to get everything in place. And so finding a way, whether it's the seesaw mechanism or it's just the fact that they need more time, the transition could be something that would get a good look, and there's probably a lot of things they could tweak. Many of them would have different impacts, but from a policy standpoint, I think that's a very good idea. But really, around the benefits when someone's thinking about IPO or just going public, which isn't always via IPO, the first thing I ask is, how brave are you? Because you're going from what is basically a semester end exam to not just quarterly, you're really getting tested every day, right? Your price is up. Smaller reporting companies, your volume is potentially lower, and so you're going to see more volatility in your stock, and you're not going to know why. And if you can get over that hump and you're ready, everything else can fall into place, right? Because a little bit of it is learning to ride the wind, because you can't influence your stock price just by saying one thing or another. And sometimes you'll get a reaction from a press release that you thought this is great news, or this is not that great news, and you'll get the opposite reaction, right? And so that's the first piece, is to understand that they're taking a little bit of the hand off the wheel when they do it. That said, preparation is everything. Are you ready to IPO is also in that first set of questions, right? What is your governance like? Have you looked at having an independent board of directors? Making all those changes and going through an IPO process and following through with it is just a guarantee that you're going to have some hiccups. And they're all things that people can get over. But for the smoothest possible transition to being public, you need to think about it 2 or 3 years out. And it's not that you have to have a plan that's a 3-year plan and execute on it specifically. It's possible to move into it, but you need to know that it's on the horizon and that you're going to start being a public company before you are a public company, or it's going to be hard. And then on just some of the changes, I would say, the process is very rigid. We all know the steps, and good counsel, good advisors will educate you on the steps early so that you know what's coming. There's always going to be some kind of surprise, but I think that the education and finding your advisors early, and finding advisors you can trust, and that you can ask questions without feeling stupid, you can ask questions without feeling like you're learning the hard way, that's a big part of it. And so going through that process, once you see the IPO on the horizon, and understanding these people are going to be on my team, I need to be able to go through the crises as well as the fundraising with them, is going to go a long way. Because once you're public, if you have a great company and the stock is down, activists, plaintiffs, lawyers, there's a lot of good reasons that you need to be ready with a team, and it's not just because your stock price is now available to everybody.
That's great. Thanks, Josh. And I'll say, the question of how brave are you, I feel like that goes back to your analogy, Sean, of, are you ready to be a parent? How brave are you? Sean and Nolan, just sort of to close out our discussion about this concept of, choosing whether or not to IPO and entering the public market, do either of you have suggestions on improving the IPO process that you'd like to share?
Yeah, sure. So I think the journey leading into the public offering is one of the most vulnerable times in a company's journey. The idea that if you attempt an IPO and you are unsuccessful, it implies this company probably shouldn't be in the public setting, and therefore you have lost one venue for an investor exit. So if you go out for an IPO, you really need to make sure it's successful. And that's what I mean, it's the most vulnerable period. So you have to, match up several different things. You have to match up the pipeline maturity or company maturity, as we were discussing. You have to match up, market conditions. So is the broader capital markets favorable, and is it favorable for the sector of company that you work in? But there's another factor, is that you have to ensure you don't have stale financials. And so that, compared to the other two, is something that should probably not influence as much the decision on when to go public. And so the question of can the concept of stale financials or the periods in which you can consider going public, given the quarterly financial calendar, be somehow adjusted, because what you want is to go out at the right time for your company relative to the markets. And I would argue for some sectors, and I think biotechnology is a good example, financials that are 1 month stale is probably not going to change an investor thesis about the company, yet it could dramatically change the prospect of the IPO if you need to push the IPO to a different window. So I think that's an example of some of the little bit of inflexibility in the process that could drive behavior of companies and therefore push them into windows that are less ideal for IPOs.
Yeah, I think that's a good suggestion. I can remember even in our process some of the stops and starts relative to timing windows based on financial staleness. And so if investors are eyes wide open that they're going to invest on financials that are last quarters versus the current and know that update's coming soon, seems like a reasonable idea. So I think that's smart. I do want to start with in the spirit of always count your blessings. What was very helpful, which is the emerging growth companies designation. But per your point, it's a vulnerable window, because if you are a private company and you try to raise a private financing and that private financing fails, it happened privately, you can probably regroup. You can probably take a couple of months and retry the private financing. A public financing is by definition public, and so a public financing failure would be a public failure. And so it is a vulnerable place for companies. And without the ability to do the TTWs and testing the waters meetings, which you have, of course, as an emerging growth company, you couldn't appropriately de-risk an IPO. It would be much harder to do it. It would feel far more scary, because you have the chance to, and it works for both parties, investors and shareholders and companies alike, because you have a chance to educate. Investors like to invest in lines, not dots, and so you have a chance to educate with TTW on what the business does, the financial performance, ideally come back again and say, hey, remember that thing we said we were going to do? We did it. So investors like that. Equally, you will get comments in those meetings like, well, this is a great business. I really hope it comes to market. You're like, well, great. If enough people are saying, I hope it comes to market, that in many ways de-risks the trigger moment. So that is it reduces the cortisol level on listing day. So I think that was kind of a real blessing. I will say, it's funny. I was sitting out there and did a QR scan of the ideas listed, and I was like, these are all really great. Do you even need me on this panel? So credit to the SEC and whoever put those together, because I think there's some quality thinking in there.
Yeah, thank you. And our Small Business Advocates Office certainly does a great job pulling this together. And just for folks who may not be aware, the Test the Waters rule that Sean's referring to was an accommodation that the Jobs Act added for emerging growth companies, and then the Commission expanded around 2019 that allows for, testing the waters prior to your effectiveness, which we've heard has been very useful. I'll also just mention, Josh, you talked about, are you ready to go public? And we talked about it being the most vulnerable period in a public company. And what I hear a lot is some of that vulnerability is also, if you have good advisors, they're really kicking the tires on your governance and kicking the tires on your ability to kind of maintain quarterly financial reporting. And I think that can be a big stress factor on companies choosing to go public, is are they really ready to have their tires kicked in that way? Now, I'll use that as a transition to talk about what's the experience like to be a public company. So you've gone through your vulnerability, you've kicked the tires, you've managed to have a successful, a public offering. As you, and Nolan, I'll push this to you first, as you transition from going, from a private to a public company, what can you say about your company's experience during the first almost year and a half of being public? And I'll keep pushing it back to the recommendations piece of the discussion, which is, are there any changes that you'd recommend to the process, again, to make it more attractive?
Yeah, the biggest difference, I would say, it feels like you're in a fishbowl. Everything you're doing is visible. You have to make public disclosures about material events, about hiring new members on your C-suite management team. None of those disclosure requirements exist in the private setting. You're really just dealing with the venture investors or other types of investors that you have in the cap table at that moment. So it's a very different picture to think about the public view of the company, whether it's pipeline updates, financial updates, management team updates, strategy updates, and so on. In terms of the recommendations, I think the idea that it's a requirement to have quarterly filings is certainly something that could be, revisited. I'll take our sector as an example, and I mentioned this earlier. Revenues and profits are not something that really matters in the biotechnology sector until you have your first approved product, meaning your first dollar of revenue. Before that, investors are primarily just focused on how much cash do you have and how much cash you're burning. So it's, there are two numbers that really matter to biotechnology investors until the first approved product. So the idea that there's 4 filings with a great degree of work that goes into them just to disclose the two numbers that investors care about is something I think that could be revisited. And I think of the whole thing as being very market driven. So if you reduce the number of required filings and the market does not believe you are providing them with sufficient information, well, guess what? They won't buy your stock. You won't have any liquidity. You'll, I think, realize very quickly that you need to, on your own, put the appropriate degree of information out into the public domain to attract interest into the stock so that you have the right liquidity so that ultimately it can appreciate. So I think it's very, will be very much market driven if that's the direction that it heads, because the market will tell you need to provide us with more information than what you're providing us. And that's probably the way to think about the public markets in general, is that the market drives a lot of the thinking around what to disclose, how to disclose, when to disclose it, how much detail to give, and all of that.
Yeah, so it sounds like a little bit, maybe allow for a little more private ordering, at least with respect to cadence, and maybe even some of the substance of what's required.
Yes, correct.
Sean, I'll push it to you now, and you're still in your first year as a public company. You mentioned having your, recent earnings call for your first year results. What are your experiences been like so far, and are there any changes that, based on pain points that you've identified so far?
It's funny. I would say in large part it's been positive. I mean, it's neat. I think Armada's ready. Equally, I watched the ways that even just this kind of brave reality of the scrutiny of the public markets bears out operationally. And I look at them and I think we're a healthier business because of it. And so, the years leading up to IPO required really putting more gears into the machine and putting oil on those gears and just making it feel finer tuned in a way that I think ultimately serves our customers and our members in a more productive way. So there's this interesting side effect. So, but it's not all, so I'd say in large part positive. It's not all, it's not all rosy. Of course, you have this volatile stock price, and sometimes your stock goes up and down. You're like, what? We didn't do anything differently. Based on sector rotation or swings. I mean, that's just kind of a truth. That's what you sign up for, and you have to brace your team for that truth, and something that you just have to psychologically manage. In terms of suggestions, I think I like what you shared. I won't repeat it. I will share just to kind of bring you in the walls of Armada. I mean, in near term, we're of course planning for building out the teams, investing in everything that's needed to be able to support Armada in a 404B environment. The trigger that's always the toughest in my view is on kind of float, because your float is dictated by market cap, and that could change very, very quickly in a way that's completely out of your control. So even if there's like a 2%, 3%, 5%, 10% probability that you hit that, you can't be surprised by it. So it's almost the same as not even having the trigger, because you have to plan for it and you have to put forward kind of the resources and capital to build out what's needed, in the team to do it. And so that is one, when you're living in our seat, you're like, well, interesting. I cannot be surprised. We need to, of course, be in compliance with all the regulations. And even if there's an odd probability that it flips, companies are going to do it. And so, I mean, it seems like that's feedback you've heard before, and clearly based on the listing and the QR codes you have. So would echo that. And I will share, like, the North Star that I'd offer for anyone thinking about how to ease the path to companies entering the public markets is less efficiency and more cost. And sometimes those are connected, but not always. And the ones that the moments where vulnerable would they give you the most pause, they were the cost-oriented ones. And obviously this isn't something the SEC can wave a magic wand and adjust, but I remember looking at the D&O insurance quotes and like almost falling out of my chair. It's like, wow, that's millions of dollars that could go to serving our customers and serving our members and product innovation, millions of dollars. And and yes, you plan for it and you manage it, but anything that I think with any idea, when filtered through, does it have the chance to materially reduce the cost? Of course, without the transparency compromise. That's kind of a clear remit and mandate. I think those are the winning ideas to pull more entrepreneurs into the public markets.
Did you want to go ahead, Reed? No. Okay, good. So Josh, I'll turn it to you, again, from the outside counsel perspective, and I'll give you the question in terms of benefits and challenges, but this time, benefits and challenges to staying public and, any recommendations that you might think of.
Yeah, I'd say it's probably, it is easier to be public today than it was 20 years ago. Technology has definitely equaled the playing field. It's easier for anybody to look up disclosure, to see what others have done, to see what hasn't worked, has worked. I think that one right there just has made a big difference in how I practice and in how my clients are getting advised. But on top of that, there's also been adjustments, right? The new definition of small reporting company has a big advantage, especially for biotech. The pre-revenue, you're not over $100 million in revenue. You've got a long ways to go before you're over the market cap. Those things have made it easier. On the other side, it's harder to stay public if you're on that cusp, right? The stock exchanges have lost their tolerance for multiple reverse splits. They've lost their tolerance for low stock price, low shareholder equity, and so it's harder to stay on the national exchanges. So the OTC is there, and there are companies landing on it every day, and that's where I think the blue sky recommendations we heard from Commissioner Ueda was hit very hard for several clients, because when you're on the OTC, that is a lot of work for them that they would love to deploy in another way, right? And if there were a unified system, or even something more than 38 states in a manual, I think it would make a big difference for a lot of companies that have proven at that stage that they can move back up and they can be very successful. But many of them right now are in that fight. But really, just being public, staying public, I think is easier now, because also we have a lot of C&DIs. There's so much more from interpretation. We've got third-party bloggers. We've got secondary. There's more material out there than ever before. The key thing is, if you use AI to do it, you're probably going to get the old rule half the time. So we have to be really careful. I've had clients say, I put this into ChatGPT, or I Googled this and here's what I got. I said, that deadline, that's the deadline that used to be for 13 Ds. Let me tell you what it is now. And so, the technology is something that we need to learn to use. We need to learn to filter out the old stuff. But there are more and more tools every day available to our clients that they can look at those things and have a really good idea and try to maybe shortcut some of that and get the best advice possible quicker.
And let me just ask Josh, are there any issues that you find tend to arise more with the small cap companies as compared to larger public companies? And if so, what are those?
Well, it's usually going to be a resource constraint, right? It's not just the money, it's the people, right? The difference between having one person who's completely dedicated to IR and having an maybe outsourced IR function, or your CFO spending 20% of their time on investor relations, are night and day, right? And so as you scale through that, having more than 3 accounting personnel, having anybody in-house who's a lawyer who can help lift the burden. All of those things are advantages that a lot of smaller reporting companies just don't have. Many of them are running on a flat structure, especially biotech. You're working with dozens of people, not hundreds or thousands. And so things like pay ratio, pay versus performance, they don't necessarily hit for them as hard as they would for a larger company. So I think the scale disclosure works. Maybe we can talk about where the scale hits. But yeah, it's changing in good ways. I mean, the one thing I will say, just to butter the bread of our host today, it has become easier to work with the SEC over the last decade. We get a more helpful vibe from the SEC. It's hard to put a finger on it, but it's more of a, yeah, here, it's not just you have a problem, it is you may have a problem, right? And I think the tone change has been a very comforting thing for our clients.
Well, it's great to hear that that's the case, because I think, you know, at the staff level, there's a concerted effort to try and be, you know, helpful and you know, whether that's answering questions or, you know, informally through interpretive channels or, you know, formally or through the review process. So it's great to hear that that's been received. Reed, I'll pass it to you now. You know, again, the challenges of staying public, any thoughts on that? Any recommendations for us to think about?
Just a few. But yeah, no. So we've talked about increasing efficiency, reducing costs, and I think for the smaller public companies that are, you know, have been public or at least recently have gone public, access to capital, particularly in the biotech industry, is extremely important. The ability to go out into the market, you know, as soon as possible, because you know, for some of these companies, or most of them, they might be doing 1 to 2 capital raises a year, especially early on when they're trying to build out their pipeline, increase their resources. And so the ability to use Form S-3, so shelf registration process, I think is one area where, you know, I encourage the SEC to take a closer look at and explore how it can be modernized, reformed, and, you know, potentially to expand the number of issuers that can use Form S-3 for primary offerings, especially within, you know, the first 12 months of being a public company, and potentially, you know, moving it back to 90 days after IPO, and, you know, exploring the ability to get on the shorter form registration statement quicker. And then, you know, in that regard, as a smaller public company, if you are have a market cap that is below $75 million, you fall under the baby shelf rules, which can be, you know, highly punitive to some of these companies when they are looking to go into the markets, especially if they have an at-the-market offering currently in place. It reduces the size of the ability to go into the markets and sell to 1/3 of their public float. And so I encourage the SEC to explore eliminating that requirement, or you know, drastically reducing to the smallest public companies if desired. Also, we've talked about resource constraints at a number of smaller public companies, and, you know, this goes to the use of Form S-3. What we've seen, unfortunately, is in some of the public companies that may not have a large in-house counsel, or maybe no in-house counsel, or just not technically the most sophisticated in the 8K requirements, for instance. There might be a missed 8K by an hour, a day, and the ability to not use Form S-3 because of a deadline of an 8K that, you know, potentially may not even be material. It's just being filed because of an 8K trigger is also something that is highly punitive to the smaller companies. And I think not being able to use that for 12 months is something I encourage the SEC to explore drastically reducing or eliminating. But so there's some of the ideas that I just want to throw out on the shelf registration process. I know the INVEST Act in particular has some recommendations on changing the threshold for WIXI status, which I think is also important to consider, and also broadening the testing of the waters. That's pre-IPO, but I think that's also INVEST Act, and, you know, I encourage that as well.
That's very helpful, and I think it's sort of consistent with what we heard from Nolan in terms of, you know, one of the benefits of being public is the quicker access to capital, or I think it was Nolan, and, you know, how can we make that more attractive in order to, you know, not just reduce costs to increase the attractiveness of the public markets, but also, you know, have some carrots there too.
Oh, I have one more.
Oh,
Since you're taking them.
Go for it.
The expiration of the shelf registration statements. I think moving that to past 3 years or 5 years or down the road, I think would be very helpful.
That's great. Thanks so much. So I think we are running a little bit shorter. So for the next section, I'm essentially just going to pose the same question to each of you to take in turn, which is, you know, do you have any advice for companies considering an IPO? And if so, what is it?
Am I starting? Yes, I think time and people. It's like a lot of comments have been made to start a couple years in advance thinking about it. Do that. So that's really important. I mean, we were doing mock earnings calls. You know, we had plenty of time to build up the board. All that was just very valuable. It made it so that ideally the IPO is like a less of an event. So you're like operating not that differently when you're public versus when you're private. And so that's kind of the one. And then you can do that through people. And this is an area where as an entrepreneur you really don't have any excuses but to bring an experience, because it's not like you cannot find people who've managed in a public environment, because the IPO process and being a public company is a thing. So it's not like you're needle in a haystack talent finding. There are plenty of incredible folks that you can bring in that have been there, done that, you know, led IR for companies and done dozens and dozens of earning calls, taken companies public before, you know, served in the, you know, the legal world supporting public companies. So that's the real difference maker to reduce stress.
I can go. Yeah, I think the traditional IPO readiness is always in play. Just you know, getting ready in your accounting and financial reporting. The PCAOB audit readiness is one that I know takes a very long time to do and can be, you know, stressful as you're getting ready for that. You know, building out your internal control environment and your corporate governance environment to, you know, not only figure out exactly what that governance environment would look like, but actually putting pen to paper, drafting your policies, getting that well in advance, because I think leading up to, you know, the last couple weeks and months, it can be, you know, stressful for a number of reasons, but it's usually timing the market, and the last thing you want to do is go back and say, oh, we don't have our control environment, we don't have our governance in place. So I think just prepping way in advance on the typical IPO readiness stuff is important.
You know, I think it's really learning how to tell the story of your company in a way that is attractive and sort of resonates with the public markets. In the private setting, investors will spend a lot of time with the company before they invest. They'll go into data rooms. You'll have multiple diligence meetings. A lot of this is because the investment is illiquid, so they can't easily get their capital out. So they want to make sure they're making the right decision, and they know the capital will be, quote, stuck there for years. In the public setting, investors could be in one day and literally out the next. I think of, you know, Wall Street as this train, you know, moving at light speed. You have to get it to, you know, slow down and listen for, you know, 5 minutes, and then that they will either buy or sell your stock based on that, or buy into your IPO. You have to learn how to tell the story to this train, you know, moving at light speed, versus the one that's going to come and sit with you and have multiple interactions over the course of months. It's a very different way to talk about the company, the pipeline, the story, and it needs to resonate very quickly and very clearly in that setting.
Yeah, and I'd say mine applies to IPOs as much as really the annual reporting process, and that's you want to plan. There's a kind of a bell curve on drafting for disclosure that if you don't give it enough time, and I'm not saying let everybody run the clock, but if you don't give it enough time, you never get to that point at the end where you're taking stuff out and say, do we really need this? And so you end up just with more, right? That's how we all end up with risk factors that only grow, right? Risk factors that only get longer. Why do we have to do a summary? It's 15 pages. How do we get there? So plan and draft early and often and go through a couple iterations of some of those more mundane things, your business section, your risk factors, and really think about, do we need this? Is this unique to us? Is this something that an investor is going to be able to use? Some of the most complemented disclosure that we have for clients is some of the shortest disclosure. It's very efficient but effective and focuses on what's about them. And I would say that's a big part of definitely the IPO, to get that message, to be able to sell your company and communicate what your plan is. And then the second piece of it would be follow through. It's another thing to just say, okay, we're done with the deal, great, we're done with IPO, now we're public, let's get going. And you just get into that rhythm of being public and having your 4 or 5 meetings and all of those things. But take the time to test and look back. Does your charter still reflect what you are doing? Have you departed from that? Is it still accurate? That's one of those things that you can get easily 3 years into being public and then realize that you've been saying you've been doing something in your charter and not. It's optional, but you said you were going to do it. Why haven't you? Or vice versa. Oh my, something changed. We should have looked at that. And so plan, iterate, and take that time to pause, and which is hard for some smaller reporting companies because your reporting cycle is constant. So if you can find a way to build that in before you're public, while you're public, it ends up being a better disclosure, ends up being a better experience, less things get missed.
Great, thanks so much. I think I will check in with our folks over there.
Happy
Should we
to
go
open
Q&A?
happy to open it up for questions, either questions for the panel, or if you want to discuss recommendations for in this IPO and small cap space, if there's any. So the panel talked about the excellent recommendations that have been submitted, and our office cannot take credit for these. These are from everyone, all the participants that submitted recommendations, and we are so grateful. We know it takes a lot of work in preparing these and being so thoughtful in drafting, and we very much appreciate your feedback, your policy ideas. So if there's anyone in the crowd that submitted any of these and wants to talk about theirs, happy to give you that space. I was going to say, don't be shy.
You know I'm never shy, Jenny. I'm Dan Zinn. I'm the General Counsel and Chief of Staff at OTC Markets. So, Josh, we should talk after this. And I do want to give credit to our friends of the Commission for posting all of those wonderful recommendations, some of which you all noted and I agree with and may or may not have drafted. But things like preemption for OTC traded companies, things like where, Reed, I think you were headed, which is a lot of secondary offering reform. So you were talking about shelf offerings. That's something that impacts companies in our markets as well. Regulation A plus at the market offerings would be a wonderful boon for companies that need to access capital on a regular basis. On a broader level, and Luna, you touched on this a little bit, Josh, you touched on this a little bit, thinking about the public markets as more than just the exchanges, I think is a really valuable way for small companies to understand and start to get into the mode of what it is to be public. So whether it's the kind of company that Josh was referencing that might have listed and then come to the OTC market to sort of get their feet under them, really understand what it is to be public, that is a role that we play, and it is a resource for small companies. Companies that have done things like Reg D offerings or other private offerings over time, let those season and then those become publicly tradable. That is another way to enter the public market. Does not preclude later IPOing or listing or taking advantage of any of these secondary capital raising options. So all of those things are out there. I think, Sean, for a company like yours, you're on a faster track, and listing probably is the right answer. But you made the point even about public float, right? And just managing those kinds of things. There are resources out there. If anybody has questions about how the OTC market works, happy to answer them. If anybody wants to consider other of the policy recommendations that I think are really helpful for those smaller companies, things like margin eligibility, Josh, which is something you're probably familiar with as well, also go a long way towards creating a larger ecosystem for smaller public companies and allowing that kind of growth. Part question, part just, me advocating. Thank you.
Thank you. Anybody else in the small cap space? If not, I will let the panelists step down and get out from the bright lights. You have a question? Okay, awesome.
Hi, Hi, my name is Usman, CEO of Woody, a neobanking for the in-banked. First, I'm very happy that we're having a meeting like this because my North Star is to IPO one day. And I think if you ask me, I would say 10 years from now, I'm not sure. So my question is, when is the best time to prepare for an IPO? I know there's a lot of things that needs to be done before that. You don't want to do it too early. I'm assuming there are hundreds of things that you might be working on and then you don't IPO. It's a waste of time. So from your perspective, looking back, when do you think, and I would love for everybody in the panel to answer if it's possible, but when do you think would have been the best time for you to prepare for the IPO?
I mean, I think more than 2 years is too much. I think the first phase of any company, you shouldn't spend a minute thinking about an IPO or any other exit for that matter. You should just think about what you're creating that solves a problem of value to your customers. And just do that repeatedly, and then make sure the financials hang together. And then you'll be blessed with this world of, well, shoot, interesting. The business is cooking. I really like what I see in the financials. I like what I see in the strategy. I like what I see internally. Like I could consider it, and then probably like 2 years is a good time window. It's kind of like the porridge is the right temperature in my view.
I think probably 18 months, roughly the same time frame. You have to balance because as you start to invest, you put in infrastructure. That infrastructure cost will exist whether you go public or not. So, the closer you can do it to the time where you actually intend to go public, the better, because obviously that's less cost that is going into an activity that is uncertain whether you'll actually need it. But I think 18 months is probably the right time frame to start. 18 months ahead.
Yeah, too early, you're going to end up spending resources that you just don't want to spend, right? But I think the key piece of it, though, is should you IPO, right? We didn't talk about it, but the panel before kind of did. Private equity and other buyers, right, your exit events, there's some population that won't deal with the public company. They don't want to go through the proxy process. They don't want to go through the potential liability and plaintiff's lawyers that come with that. And so you would be taking them off the table if you IPO. And so you need to have someone who can advise you on what your ideal buyer population looks like and whether that fits, right? And so that's one thing that I don't think gets talked about enough. People get surprised that they come in, they have a successful company, they don't really need the capital markets because they're doing well, they're throwing out cash, and they have a hard time finding a buyer because all the potential buyers aren't really excited about going through a public company process and disclosing what they paid. So you do want to think about that. If you're 10 years out, you've got time to go through all the plays, and I encourage you to do that.
And I have to give a plug for our resources as well. We have one talking about IPO track, and it talks about kind of what companies that are thinking about down the road, thinking about an IPO, what do they need to be considering now to help prepare for them in the long term. It is, as Julie had mentioned on her panel, it is not a replacement for counsel. It is not, but it is something to kind of use as a resource to think about before you are looking at an IPO.
All right, Mark Friedman, I was on the early stage panel. So this is going to go a step further than the last question. So one of the things that I've noted over the last 5 to 10 years is there's a notable difference in pitches that are presented from early stage companies. There's the obligatory exit slide that has to be there, and we could talk over a drink as to how much fiction is actually included in those. But it used to be that IPOs was a exit route that people would talk about a lot, and you barely see that in a pitch presentation from an early stage company anymore. It's more merger and acquisition. Strategic will buy it. These are the companies that are going to be buying this company. I'm curious what your thoughts are on that. Is it because people see the IPO market as having been frozen for a number of years? They just think the process is too hard, too difficult to go through, or otherwise? Plus, there's the 6-month lockup, or the lockup that typically comes, and I'd love to hear your thoughts on how that impacted your thoughts.
Yeah, I would just say it goes to what you were saying. It's the prospect. You're just putting it out there, this wish that you're going to IPO, and the fact that you might have a public failure, and you don't want to say it too loud because you're afraid that it's it's going to discourage them, right? I don't think anybody's out there saying we're going to work our way into an IPO. You need to be ready, and I think people have gotten to the point where if they haven't performed that analysis, they're just not putting it on the table.
I think and this was discussed a little bit, I think the fact that there's liquidity in secondary markets in the private setting has probably reduced some of the pressure for some types of companies to go public because the employees can achieve liquidity on the shares that they own through those secondaries. That's if you're in a sector that does secondaries. They're very uncommon in the biotech sector because the companies need a lot of capital, so the investors are concerned about that capital going, to places other than the company's balance sheet. So IPOs are still very, commonplace in the biotech sector. I think most companies aspire to that for the reasons I stated earlier, that the, capital formation window is much shorter. You can do a round in 4 days versus 6 months. But I think on top of all of that, there's a function of how the investors in the cap table would respond to an IPO. So many of them are venture funds, and as the shares become public, they need to exit the position. So that inherently results in some different dynamics with the trading and liquidity of the shares after you go public. Some investors will hold on and continue to buy. Some will need to sell, and some of that can impact the overall valuation of the company in ways that you may not intend.
Yeah, I think that's a really interesting observation. I think maybe part of your hypothesis could be right in that it's been at least the last couple of years has been tough in IPOs. So maybe it's not what entrepreneurs want to put into the the closing slide on their deck. But perhaps even more broadly, you can stay private longer. Even if you want access to capital, I think it's become over the last decade, 2 decades, like just more of a viable option. Not judging kind of one path or the other, because I think there's puts and takes on both. But, I think because that option exists, I think an IPO is viewed perhaps less as an exit. And fundamentally, an IPO, yes, it's kind of an exit, but it's not really an exit. It's best to be thought of as a capital raising event. Yes, some of your cap table investors can get liquidity, but I don't think that's the right mental model anyway.
Well, thank you. Now I will let the panelists go, take a seat, get out of the hot lights. Thank you so much for sharing your expertise. But don't just relax too much, because now it is the audience's turn. So if you want to weigh in on any recommendations, whether it is that small and emerging, the growth stage, or public company, please come on up and join the mic and share your views.
Jenny, you've been asking us to come up and share our views about the policy, so I'm really glad to do that. So my name is Chris Miller. I'm with the National Coalition for Community Capital. And a year ago, I was in this room, and Zach Fallon, former SEC attorney, was on a panel with a venture capitalist and an angel investor. And Zach noted that there's this missing piece in the market. And that missing piece is a community-based pooled investment fund that would be available for community members to invest in, whether they were accredited or non-accredited investors, that would reinvest that capital into the community and real estate and in business projects and communities. And that is the work that our national organization has been doing for the past several years, working with communities who are interested in doing this. And of course, we are compromising. We are using a workaround of real estate funds or a business development corporation in order to do charitable loan funds, in order to do that in a way that really brings benefit to communities. But we see this as a huge need. And just to frame that, we're currently working with the IDC. The IDC is the International Economic Development Council, the largest economic development entity on the planet. And we are working with them to develop materials and to train their folks on how they can go into communities across the country of any size and build a community investment fund. We're working with Main Street America, and there are over 1,700 downtown communities there, with the LISC and the CDFI folks, and they're in 1,200 counties, and all of those organizations are very interested in funds like this. So we see an urgent need to create those funds. And actually, we heard a lot today about access to capital. We like to talk about building capital to access. Thank you.
Thank you, Chris. Anyone else want to join?
So let me read the actual one. So when you're voting after this, here's what you want to vote yes for. Create a new private fund exemption to foster small or regional funds focused on a community. Sound good? Everybody in here a yes for that? Shy, okay.
Does anyone have any questions on any of the recommendations? I mean, we did not write these. They are not ours, but I'm happy to, if there are concepts included in the recommendations that we have questions on, happy to try and address those or point to resources that are available to help better understand kind of what each of these recommendations are getting at.
The other thing I'll offer is if you've been trying to get into the recs to take a peek at them, and if you're having any trouble, feel free to grab any of us sitting on this side or out in the hall. We can help you get situated too.
Well, with that, I will at least give the logistics on how to vote. So you can use the QR code that Amy had explained before. It's on the back of the agenda if you are here in person. It's on our website if you're online. If you have trouble with either one, either follow up with SEC staff and we will help you vote today. If you are online and you're having difficulties, email smallbusiness@sec.gov and we will help make sure that your vote is counted. So when you go in to vote, you will see a number of recommendations. So there are approximately 20 for each panel. You want to select 5. It's going to allow you to only select 5 in each of the 3 panels. So when you select 5, you want to look at kind of what is going to help capital formation policy and how can I help improve that ecosystem. If you select 6, it will not let you submit it. You're going to have to go back and take one off and choose something else. If you pick one and you want to switch it out, you can just unselect it and reselect. If you do, you can vote in either all 3 categories, 1 category, or 2 categories. If you click on something and you don't want to vote in that category, refresh the page. It will zero everything out. And then you can then just vote in the categories that you choose to vote in. The key thing here, hit submit at the bottom of the page, because that will allow your vote to actually be submitted to us. The other thing is voting will remain open until 9 p.m. Eastern time tonight. Again, if you have trouble voting, please email us. We want your voice to be heard. This event is about you and about you helping participate in capital formation policy and having your voice be heard. So please email us if you're having trouble. Stop us here if you're in the halls. With that, I'll just kind of say thank you. We had 3 incredible panels, and there were so many insights, and it's clear there are so many people building and supporting and funding that key small business capital formation, and it's just inspiring to hear the stories and to hear from everyone that was able to join us today, both as speakers and as participants today. We had a wonderful discussion that was collaborative and had so many questions and interactions with our panelists, and that was exactly what we were hoping for today. So thank you so much for sharing your time with us and sharing your feedback with us. And yes, for those that are online, thank you for joining in. For those in person, if you want to mingle in Veterans Hall, which is just behind us, we'll be around. Thank you again for joining us, and we look forward to seeing you next year.